the right way to look at it, which would explain everything for people who can understand this. It's not gold rising, it's the dollar falling. So if you turn the price upside down and think in terms of what's going on in the dollar, not gold, you can begin to understand the circumstances whereby the dollar rapidly loses purchasing power, which would be reflected in the gold price. And then, if you talk about the dollar maybe losing a quarter or a third of its purchasing power, I mean, the conditions are there for that to happen even before foreigners intervene and decide to dump the dollar. You can begin to understand why the gold price, if you like, would reflect this at a far higher level.
Moneywise reported that the U.S. dollar has lost 98% of its purchasing power since 1971, but gold has maintained its value. Gold and silver prices surged against a weakening U.S. dollar overnight on Thursday, surpassing the $2,024 mark, respectively, following an unexpected move by the U.S. Federal Reserve to cut its interest rate forecast for 2024 in the dot plot. Alasdair Macleod, head research at Gold Money Incorporated, forecasts gold at $2,500 and anticipates higher prices with a significant loss in the dollar's purchasing power. He stresses the need to focus on the dollar's performance, not just gold's movement. The dollar fell to a new 4-month low on its trade-weighted DXY index against the rest of the world's major currencies, sinking by 1.4% from the minute before the Fed's announcement. As the U.S. continues to battle inflation, the value of the dollar could drop even further if it loses dominance in global markets. Experts recommend hedging against inflation by investing in gold, which has maintained its purchasing power over decades. Regarding the current economic state, Alasdair mentions recession and its significant impact on GDP growth, while gold tends to gain purchasing power in downturns. Research agency BMI, part of Fitch Solutions, predicts a rise in gold prices in 2024, citing expected investment flows. The forecast considers a global growth slowdown, a weaker dollar, and a 50% chance of a U.S. recession, potentially leading to Fed rate cuts. Now, we present the clips of Alasdair Macleod's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I mean, quite obviously, as soon as it was going to go through 2000, you could see that everybody, hedge funds and all, the momentum chasers and all the rest of it, they're going to go in there and buy it. Of course they were. So they needed shaking out. And it's if you like, a normal process. As you rightly say, nothing goes up in a straight line. But having said that, in my market report for Gold Money last week, I suggested that it would be perfectly normal for the gold price to tick back to around about 1950, which is where the long-term moving average was. On that basis, that, if you like, would be the platform for gold to really start moving ahead. But I want to emphasize that we're actually looking at this the wrong way around. It's not gold going up, it's the dollar going down. This has been very much excuse me. This has been very much the case with other currencies, while the dollar was strong, as it were. But now that the dollar seems to have turned some sort of corner and is weakening, it's a fate now being faced by the dollar as well. And I think to put it in context, people might find it a little difficult to imagine why gold should run to, say, I don't know, let's pick a figure, 2,300, maybe 2,500 or something like that, or talking about some sort of reset. But I think the right way to look at it, which would explain everything for people who can understand this, it's not gold rising, it's the dollar falling. If you turn the price upside down and think in terms of what's going on in the dollar, not gold, you can begin to understand the circumstances whereby the dollar rapidly loses purchasing power, which would be reflected in the gold price. And then, if you talk about the dollar maybe losing a quarter or a third of its purchasing power, I mean, the conditions are there for that to happen even before foreigners intervene and decide to dump the dollar. You can begin to understand why the gold price, if you like, would reflect this at a far higher level. Think what happened in the Great Depression. What happened basically was that the gold price went up, both measured in terms of goods, and this was recognized in, I think it was January 1934, they devalued the dollar against gold to try and stop prices falling, as it were, intensifying the depression. So actually, in a recession or a slump or whatever, the purchasing power of gold rises. So I think that's the first thing that we must get straight. The second thing is that where are we in terms of the recession? I believe we're already there. I know that GDP looks as if it's growing, but bearing in mind that the government is injecting probably something like 1.5 trillion into GDP, because virtually all government spending, not non-interest spending, goes into GDP in the form of suspending of welfare commitments and, government contracts and all the rest of it. This is not financial stuff. This is pure GDP. If you take out 1.5 trillion out of GDP between, let us say, the outturn for the last fiscal year to end September to the expectations of GDP at end September 2024, then you're going to see that actually the nominal GDP is either not rising or is likely to fall. Now, on top of that, you've also got the expense of refinancing government debt and all the rest of it. And that's probably going to work out around about 1.5 trillion on my figures. Now, that compares with last year, which was a little under 1 trillion. So we're talking about a 50% increase in the cost of funding as well.
Alasdair Macleod suggests that Russia and Singapore can implement a gold-backed currency, utilizing interest rate differentials to grow their gold reserves. Gold has long been a safe haven asset, and its use as a backing for the BRICS currency could instill confidence among investors and member nations alike. With debt to GDP of about 20%, a strong export position, and a basic income tax of 13%, Russia is in a strong position to put the ruble back onto a gold standard. The major consideration holding her back is the economic consequences for China, which is strongly dependent on the export trade, though her long-term plans are to become less so on exports to America and Europe. In expressing his belief, Macleod contends that the days of the dollar are numbered due to central banks' gold acquisition policies. The WGC data suggests that Singapore, Turkey, China, India, and Russia are the top states buying the largest amount of gold at the start of 2023. Singapore purchased the most significant amount of gold, 51.4 tons, while Turkey acquired 45.5 tons within the same period. China is known to get 39.8 tons of gold, Russia 31.1 tons, and India 2.8 tons of gold. Let's get back to the interview.
If you know how to do it, it's actually extremely simple. The way in which this is done is you ensure that your gold reserves are stable by setting your interest rates to ensure that your gold reserves are stable. Now, that's a complete volte-face from the idea that interest rates should be set to manage the economy. No. It should be to set your gold reserves. Once you realize that, put it in the Russian context. Russia has a certain amount of gold, official reserves in the order of 2,300 or something like that. But also, like China, Russia has gold in other state accounts. There are two accounts in particular. One's a specific precious metals fund, and the other is a wealth fund. It is believed, while this hasn't been officially divulged, it's believed that they've got a further 10,000 tons or so in those two. So that Russia is in a position where, with its central bank reserves, it can actually mobilize enough gold backing, more gold backing than America declares at 8,130 odd tons. So. The other thing to bear in mind is that with interest rates in Russia currently around about 15% or something like that, from the point of view of a Russian bank, and they would be steered in this direction, what they could do is they could walk into foreign markets, say in Dubai, buy bullion, where the interest rate on the leasing of bullion is in the order of 2%. They could just lease bullion if they want. Is in the order of 2%. Push it into the central bank of Russia, and get 15% on it. Now, that 15% under a gold standard is effectively 15% in gold. You use interest rates to create the arbitrage to maintain your gold reserves. Russia is in a position where she can do that tomorrow. And indeed, senior economists in Russia have already made this point. So I think that's absolutely clear. Singapore is, I think, very interesting because the Singaporean government has got extremely good intelligence about Asia, about global trade, all these matters. And as a small island state, it's sitting there knowing what's going on in a way in which we can just not really appreciate. The fact that she is accumulating gold, and really quite aggressively, I think gives us a very, very good message that the days of the dollar are effectively numbered. And I think this is being echoed in the gold acquisition policies of other central banks, not all of them, but you can see that how other central banks are deliberately building up their gold reserves. And I feel sure that if there was more bullion available on the markets, which there isn't because the markets are very tight, if there was more bullion available, it would disappear into the central bank's coffers. They would be accumulating it even more rapidly. The only reason they're accumulating as much as they do is because that is the only gold that is available. It's not enough, for many, many of these countries. And of course, there's some idiots like our government, who sold it all out, sold all out by 310 tons at something like $250 an ounce, And have they ever gone back into the market to replenish the situation from that obvious mistake? No, not so far as we're aware.
Historically, gold prices have remained stable or even experienced an upswing during recessionary periods. According to data from Schroders, a global investment manager, both gold and gold equities have performed well through 5 of the past 7 recessions in the early 1970s. Do you think these recent trends in the market impact the long-term role of gold in the global financial system? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.